Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode number 89 today. We are going to talk about asset allocation, equity, and debt. Gold will come in the next part. This is one series that we did last week, but due to some erroneous data, we are redoing this, and we are basically coming back with the correct data to analyze the asset allocation part. So let's first look at the markets. Markets were very choppy today. Markets were Nifty was strong. Bank Nifty, in fact, which was very weak yesterday, came back very strongly in the morning, first couple of hours, and then there were another sharp dip around noon or 1 o'clock in both Nifty and Bank Nifty. Almost looked like they are turning back down, but then in the last 2 hours they picked back up again. So we are kind of just not able to decide where we are going, although the overall longer term trend is very firmly up. IT stocks surprisingly went down today despite the rupee losing almost 0.5%, and banking stocks and PSU banks were up. So, it is not following any logical sort of narrative, but that's how markets are. So our autos, infra, pharma, everything lost a bit of ground today. In terms of weekend investing, small case performance, they were between minus 0.25% to plus 0.7%, nothing very exceptional. And the indices, Nifty closed absolutely even at minus 0.05%. CNX 500 was up barely, and small and mid caps were up in a better way between half a percent and 0.65%. So let's talk about equity allocation. So in the series that we've talked about earlier, we want to show you how, if you move from it totally in non-equity sort of portfolio, which a large percentage of people have. So a large percentage of people do not participate in the equity market at all. That may be as high as 95 people out of every 100 people. So there is zero exposure to equity in those financial books. So just imagine the number of people out there, even if you take only the middle class and the growing young population of our country. We have millions of people who have not exposed themselves to equity at all. Of course, there is no hard and fast rule that you have to, but equities over a longer period have shown to be much more productive in terms of giving you inflation beating returns than any other asset class. So the traditional Indian asset classes of real estate, gold, and keeping money in the bank, they are fine to some extent, but they are nowhere in comparison to equity when it comes to returns, and of course volatility as well. So a lot of people are unable to allocate even a very small percentage of their portfolios towards equity, which is extremely playing over safe actually. And if you are not even exposing yourself to risk assets like gold or risk hedging assets like gold or real estate and keeping your money in total debt or in the bank, you are actually losing ground versus inflation. So that definitely one should not do. Even if you don't come to equity, you must invest in other asset classes where at least you will be beating inflation. So real estate over the longer period, I would imagine in India has given a CAGR of somewhere between 7 to 8%. and gold over a longer period has given a CAGR of somewhere around 11 to 11.5%. And there are newer instruments like SGB, etc., which have a 2.5% interest and no capital gains, etc. So that sweetens the deal a lot. But with equities, even with index investing, you could look at least double digit returns, if not high double digits, low double digits. And if you are able to follow some strategy or do some direct investing on some basis, maybe slightly higher also. So the idea is you must allocate to equity. Now this chart is showing you returns from 1985 till date to about 35 odd years of returns, and 100 rupees starting in the bank has become 1859 over 35 years, and we have taken the average interest rate each year to come to this figure. This is very, very approximate. Then you have this Sensex going from 100 to 12,800 on a 100 based index. So 128 times over this 35-year period. Of course, with its due share of volatility, where in 2008 it dropped more than 50-60%, in 2020 COVID also it dropped quite a bit, and 92, which is not really visible here, it went from 1100 to about 580 something, so almost halved there as well. So huge volatility in the Sensex, but over a longer period you've really done well in equity. So this chart basically shows that had you allocated even 20% to an index like Sensex, your returns from 100 would have gone to 4,000 instead of 1859 with just the bank. So this is the impact of asset allocation. You've allocated 20% of your assets to the capital market, and it more than doubled your outcome over this long period of time. If you went 40%, it more than tripled your returns over this long period of time. If you went 60%, it went more than 4x, almost 5x of the returns, and so on and so forth, right? So you get the idea that allocation to equity is very important. Allocation to other asset classes are also very important, and good allocation to equity, depending upon your risk profile, your risk taking ability, your psychology, is also very important. CAGR progression is another chart that is very interesting. So normally most people see the markets in a very short term, with a very short term lens, that we will come when the market is low, we will get out when the market is high, and that will be the end of it. It doesn't work that way. For 99% people, they are not able to time the market. Even 99.99% people, I would say. Only very few handful selected professionals who really have a third sense, sixth sense, third eye and sixth sense, are able to do that repeatedly. Once in a while anybody can do, but repeatedly to get that consistency of picking near bottoms and getting out near tops is a skill, is a magical skill. So unless you have it, and if you have it, you're probably not watching this. So my sense is that if you see the past 35 years, what it is telling you is that regardless of the short term volatility, this is the Sensex, and you can see the CAGR, if you had invested in 1986, went from 30 to 80 first, then by 1988 it dropped to near zero, then by 1992 it went to 40%, and then it gradually eased out over a long period of time to 14.5%. So once you are crossing your 5-7 year barrier, then your long-term CAGR average will not move much. It will just stabilize over time, and you will stop worrying about this market fluctuation at that point of time. But it will require that much of tapasya to reach there, to cross that line of fire where you don't have to worry about the market volatility. And the long-term average of your returns becomes smoothened out. This is what this is showing. So again, of course, this is the long-term average of money in the bank, 8.5% over last 35. But by itself, that is not bad. But is it beating the inflation? Is it making your life go ahead, in terms of having a better quality of life, so on and so forth, and improving your life or your purchasing power? So you saw the two extremes on the Sensex and on the zero equity, and then you have the middle ground, where 20% if allocated to Sensex, you would have still got 10.8% CAGR over this longer period, which is also very good. So even if you allocated 20% to the index, even then probably you would have beaten the inflation nicely. If you had allocated 40%, you would have got 12.2% CAGR. Still not bad. So depending again upon your risk profile and your psychology, you would have allocated. The cardinal rule is never be out, and my own personal thing is never be fully in. So you must do asset allocation, and your financial planner can help you in that. So this is drawdown progression chart. This is also very important because not everybody can withstand their gross capital go up 40-50% every other year. At least I can't. I don't have that heart to see my net worth go up 40-50% every year, even if I know that this is a positive outcome in the long term, right? If I'm able to go through these reverberations and knowing that at the end of the tunnel I will still make a lot of money, but I may lose my heart on the way, I don't want to do it. Simple as that. If you may be a daredevil in your younger years and you may have less capital, you may deploy it in cryptocurrency and see the 20% falls in a day. I may be at a situation where I'm looking at a stage of life where I don't want to lose my 30 years of hard work in case things go against me, and I can't take that chance. So I don't want to have that probability high, at least in my view. So it all depends upon you. You are the linchpin on how this can work. There is no standard formula. So 40%, 50%, 55%, these are the kind of drawdowns you would have seen had you been totally invested in the index. And had you been invested in individual stocks, this may have been even more. You can withstand this in your younger years. As your responsibilities and goals and financial assets move up, maybe you will not be able to do so. Some people are still able to do that. So depends upon you, but you can see that you can reach some sort of a compromise between risk and reward. So if I say, if I went just 20% exposure to equities, I still would have seen a 32-33% fall in 2008. But had I also exposed it to gold, another 20%, and I'll show you in the next part of this series, this would have totally gone off. You would not have seen a drawdown of even 20%. That is the beauty of asset allocation in various assets. So we are currently considering only two assets here, and hence there are still steep drawdowns with equity. Once you add more asset classes and diversify across them, which we will see in the next part, this will go away. So this is all the small session that I wanted to have, so that you are able to at least start thinking in this direction as you are growing and as you are getting older. You may not do it today, but maybe at some point of time you may remember this video and you may want to try something. Another thing that I wanted to announce using this daily bite is that we are moving to a new business structure. We have moved, in fact, from today. So we are now registered as Weekend Investing Analytics Private Limited. We are now a corporate research analyst company under the SEBI license, and there is no advisory that we provide. Only research products are available based on your own risk assessment. So this is the change that is happening on the business front. Nothing changes from a user or usability point of view, or nothing changes in the management. There is no change as such, just a structural change in terms of how we are doing business. So this was just a notification. No action is required from your end. So thank you for watching this, and I'll see you in another video. Bye.